At this point, we will move on to our second paper. Katerina Petrova will present monetary policy across inflation regimes.
Thank you. Just to say, I just moved to Kafoskari, and so I'm very glad and relieved to be in Europe permanently back. This is joint work with Valeria Gargiulo, who's a PhD student in UPF, and this is the first chapter of her PhD thesis, and Christian Matthes. And this is the paper on inflation regimes. In particular, the empirical question that my co-authors ask is whether the effect of monetary policy depends upon the underlying level of inflation and whether other macroeconomic outcomes in the economy depend on the underlying level of inflation. Most of the research is on linear models with constant parameters, but there is emerging evidence now from various experimental papers showing that actually agents, both firms and consumers, may behave very differently when inflation is high. So they can form expectations about the future differently, respond to information in different way, pay more attention when inflation is high, and that may affect economic outcomes. So in the presence of this type of state dependence, of course, linear models can give you erroneous empirical conclusions because they would just average across these different regimes. So the paper has a simple, self-exciting Bayesian VR. Since I'm the econometrician on the paper, I'm going to focus on the methodological contribution. And you see the model is very, very simple, but there are two things that we're going to do slightly differently from the existing literature. So just to manage your expectations, I don't think you learned anything new about inflation from my paper, but I'd like to think that the tool from the paper can be used for a variety of setups to deal with processes like inflation that may have this nonlinear state dependence. So the methodological contributions of the paper are twofold. First, the usual approach in the literature will have either conditional mean of the model being regime dependent, or whenever you allow for regime dependence in the variance, that will be done in the second stage. So you first estimate the threshold using conditional mean regime dependence, and then you plug it in, and then maybe in the second stage you can allow for dependence in the variance. So the first thing that we do differently is we actually allow for regime dependence in the conditional variance in the first stage. That's going to help us identify the threshold parameter, and we're going to argue that, for example, in macro series, we do have this regime dependence in the variance, and this is going to help us get a more precise estimator for the threshold parameter. Now, the second contribution is about estimation. So there exist two approaches in the literature: a frequentist and a Bayesian approach to estimating these models. Now, the frequentist approach will set up some sum-squared residual objective function, get the threshold, estimate the threshold, then do inference on the beta parameters and the var parameters, or the other model parameters. And the main problem is that when you have vars, as you know, they're highly parameterized. We have small samples. We would like to do some kind of regularization. Now, there is the second approach in the literature, which is fully Bayesian. So there, of course, everything cast in Bayesian. That helps with the dimensionality. But the issue is that the fully Bayesian approach that deals with the threshold parameter requires characterizing this really highly non-standard posterior of the threshold parameter, which of course requires MCMC complicated metropolis step and makes this very, very tedious and very hard to estimate. So what we're going to do here is we're going to combine these frequencies and Bayesian regularization, and we're going to be allowed to do that because the threshold parameter, both frequencies and Bayesian estimates for the threshold parameter, are super consistent. So they're going to be converging to the truth at a faster rate because the posterior for this threshold parameter is going to contract at a faster rate. Basically, we are allowed, at least for large samples, to ignore the parameter uncertainty. And I'll be more clear about this. In terms of advantages relative to frequencies estimators, we can deal with larger dimensions because we can utilize regularization or priors that are widely used in the literature. In terms of advantages relative to the fully Bayesian approach, we have a very fast and efficient Bayesian sampling algorithm. The code is online, and I think we've had some people using it already. So it takes a minute to estimate this model and doesn't require any MCMC. And then in terms of, I should probably mention this a little bit in terms of advantages, I guess, relative to Markov switching models, Markov switching VARs and DSGs that are widely used in macro literature. I'd say that the fact that the regime switch is guided by a state variable that will be chosen by the researcher in these self-exciting models provides a very simple and transparent way to understand the nonlinearity. Just to give you an example, with the Markov switching model, you have a latent state variable that follows a Markov process that switches, but that's very hard to, for example, explain to policymakers, why did you switch regime and what is driving this latent state variable? Whereas here it will be really transparent. Okay, so I will, like I said, spend most of the time on the methodology and the algorithm, maybe show you some Monte Carlo exercise, and in passing, maybe highlight the main takeout from the empirical exercise. Now, the standard, the first univariate threshold of the regressive model was introduced by Tong in 1977, generalized in various directions by Tong and Li and Chan in a sequence of papers, including papers in the Annals of Statistics. So here we're looking at an M by 1, so multivariate version of that model. I don't think I can point. Can you see anything? No. Oh yeah, you can. Perfect. So Y is an M by 1 vector, and of var P with K regimes. So just ignore that sum for the second. Inside that bracket here, you have your standard VAR of order P, nothing different. The only difference is now they're indexed by I, which are the regimes going from 1 to K. So now the coefficients are regime dependent. And there is this indicator function psi that depends on this parameter gamma, which is a threshold parameter that's K minus 1 dimensional in this K regime model. And that that indicator function is just 0, 1, depending on where your state variable is relative to the different thresholds. Now, the state variable, what is assumed for it? Usually that's either fixed exogenously, so that's the threshold model, or it could be a lag of the dependent variable. It is always a scalar. And if it is a lag from the dependent variable, this model becomes a self-exciting model. That's the difference, because now you have basically the left-hand side lags of the left-hand side variable switching your regime that then gets you back to the left and the right-hand side. And for the moment, I'm keeping the variance fixed. I'm just telling you what the standard model does. So these self-exciting models have this beautiful nonlinearity through the indicator functions, extremely simple to write down and also to estimate. But the asymptotics is not that simple, but it is relatively simple because you get piecewise linear models. That's very nice. It also will allow very simple estimation. In the same time, this self-exciting mechanism can actually capture a lot of very important nonlinearities in the data, and this has been documented in all these old papers as well, in this old literature, particularly in things like cyclical data. The paper that derives the limit theory is the Chan Annals of Statistics, where he derives the asymptotic distribution and show the super consistency of this gamma parameter. And I'll talk a little bit about that. So how does standard estimation work in this model? Well, first of all, imagine you know gamma. If you know the threshold, you can just go back, you can look at the periods where you were in different regimes, and then you can just split the sample into subsamples, and then you just do your standard estimation over the subsamples as if nothing. And that turns out to be, as long as you're staying in each regime fraction of the sample size, root n consistent, asymptotically normal, and everything, you can do everything on the subsamples as if there was no nonlinearity. Now, if gamma is unknown, you have to estimate gamma. And the way that people do this in the frequentist world, they would set up a sum squared residuals function, okay? So everything here is stacked. So beta has all the autoregressive parameters, and then gamma's minimize is the minimizer of the already minimized sum squared residuals with respect to beta, okay? And equivalently, you can get this from a joint minimization with respect. So gamma is the minimizer from the joint minimization. So what you do is you minimize the sum of the squared residuals with respect to beta for a given gamma. So that's a function of gamma, and then you minimize with respect to gamma, and that's your estimator. The standard assumption in order to get gamma, the identification assumption, is basically for any pair, if I consider the vectorized regime-dependent parameters, I need to have that beta j is equal to beta I for each pair. So at least one element in that vector needs to differ across a pair of regimes in order for me to be able to consistently estimate that regime. Otherwise, I have no hope, right? And so the really cool thing is that, which is what Chan finds, is that actually that estimator for gamma is super consistent. It has a rate n as opposed to the square root n rate. If you want to know why, like the intuition is if you write the population regression function, it has a discontinuity. And it's that discontinuity that gives you this faster rate of convergence. And so because of this fast rate of convergence, what the frequentist estimators do is, well, you estimate gamma in the first step, and then you basically you use gamma hat, you plug it in as if it's the true value, and then you do inference on beta as if this was the true value. Now, this is what we were told in econometrics never to do. Like, when you have beta 1 and beta 2, do not plug in beta 1 hat and then do inference on beta 2, because that's not allowed. That's not allowed when they have the same rate of convergence. That's allowed when you have the faster rate of convergence, because you will have some distortion coming from the uncertainty around gamma, but that's higher order. That's not going to affect the limit distribution. That's going to affect the next terms. Okay, so that's what the existing literature does. So what's novel in the procedure? We just, as I said, we deviate in two important ways, but I think things are still very simple. This is the var from the previous slide. The only difference is that now we are actually modeling in the DGP the fact that the variances are regime dependent, okay? And we're also going to be Bayesian. So because we're Bayesian, we're going to have to, whether you are really Bayesian or you just want to regularize the problem, we're going to have to impose some distributional assumption on innovation, and we're going to write some priors for beta, sigma, and gamma. Because we want fast things, of course, we're going to work with conjugate priors, you see, and we'll also assume that the prior for gamma is independent. In fact, we're going to have the simplest possible prior for gamma. We're going to have a discrete uniform prior. So we're just going to give, we're just going to consider grids of points and k minus 1 Cartesian products of grids of points for gamma. And then we're going to maximize the log posterior density of the model. So the log posterior density, which we can write as the log likelihood of the model, plus the weighted sum of the log priors, where here the omegas are basically the effective sample sizes of each regime. And then, we can write everything in matrices. This makes it very simple to derive the closed form expressions for the posteriors and so on. WTI are basically the indicator functions. So the capital W for each regime I is an n by n matrix that has in the diagonal the 0 1s for the regimes. And then you can rewrite the likelihood in a neat form like this, where you have this chronicle product here. And then the maximizer, we're going to look at the maximizer of this log posterior. And similarly from before, joint minimization, the estimator for gamma coming from the joint maximization is the same as the one that comes from maximizing the already maximized log posterior with respect to beta and sigma. So you can do some algebra here. This thing, the maximized posterior is the posterior evaluated at posterior modes. So this beta check, sigma check at the posterior modes. And then, we can also use the fact that the prior for gamma doesn't really matter anywhere apart from the area over which we're maximizing. And what that means in practice is we're going to evaluate the log posterior at the posterior mode for many different grid points for the threshold parameter, and then we're going to maximize that numerically with respect to the threshold. Now, because gamma is going to have a posterior that has a contraction rate n faster, we can show that the posterior of the standardized centered var parameters, whether you draw from the posterior of gamma, whether you use a plug-in consistent Bayesian estimator for gamma, or whether you know the true gamma, actually those are, as the sample size increases, these posteriors are the same. And that allows us to avoid the expensive metropolis step. Okay, so everything is in closed form because if we assume Gaussian likelihood, then we have the standard Wishart, normal Wishart prior, we can derive the posterior, which is now conditional on gamma. And so, you have all these posteriors depend on gamma through these W weights that have the determine the regimes. And you have the standard, other than that, you have the standard result, now one for each regime. In practice, what the algorithm does is what I told you before. For each point in the grid, in the k-1 Cartesian product of the grid for the threshold, we compute the posterior modes. We then evaluate the log likelihood at the posterior modes. We evaluate the prior at the posterior modes and numerically maximize this posterior with respect to gamma. We store gamma hat, and then we use gamma hat from that step as fixed, plug in, and then draw from the posterior, from the closed form posteriors that I'm giving you here. That's all. That's the whole paper. There's a Monte Carlo exercise where we look at, okay, how does this work in practice in terms of, maximizing this likelihood that has in the first stage the variance dependent regime dependence. This is really simple, but Valeria, I think in her second chapter is working to get the theory for this and also have a much more complicated setup. But here we have like just a mean variance model. I'm also looking at small and large sample. As an econometrician, I always want to know what happens if the sample size increases, not really if the error is small or big, whether they're going to zero or not. We have 4 DGP. So DGP1, everything's constant, 0, 1, standard, normal, random variables, nothing else. In DGP2, there is a break in the mean. So there is a regime dependence in the mean, and you have this self-exciting mechanism because it's determined by lag values of the left-hand side variable. In DGP3, we have constant mean 0, but regime dependence in the variances. And in DGP4, we have both mean and variance regime dependence. True value for gamma is 0, and we're going to just look at what the constant parameter model does. I mean, you know what it does. Regime-dependent sum-squared residuals, that's a standard model in the literature, which only uses regime dependence from the first moment. And then we have also the one that is in Chan and Tsai, which uses regime dependence to estimate gamma in the first moment, but then you also allow regime dependence in the variance in the second stage. And finally, our likelihood approach. I'm just going to show you some root mean squared error. I know it tables a little bit hard to read. I will point to some of the main conclusions. So in DGP1, when there is no regime dependence, obviously the constant model does really well. You have errors that drop quite dramatically as you go to the large sample for the mean and the variance. The other models, the sum squared residual model, also has errors dropping, but they're a lot bigger, and so does the one with the second stage variances, and so does the one with the likelihood. And that's to be expected because you're modeling regime dependence that isn't there, so you basically lose efficiency. But crucially, they're still valid. You can split samples when there is no regime dependence. In DGP2, there is a break in the mean. Of course, once there's a regime dependence in the mean, the constant model is failing dramatically, and there is no fixing it. Also, the variance is wrong because the mean is wrong and the variance is based on estimating the mean. The sum square residual model does pretty well like expected. So basically, we have the errors dropping for the mean parameters. You have very precise estimation for the threshold. The same for the one that's augmented with regime dependence variances. But crucially, our likelihood approach does equally well. So basically, allowing for regime dependence in the variance when there isn't such regime dependence in the variance doesn't contaminate our estimation, which is a good thing. In DGP3, there is only regime dependence in the variances. So of course, here, the sum square residual model cannot estimate at all the threshold because it's only using information from the mean. The mean is still consistently estimated because it doesn't really matter whether any split works, right? There's no regime dependence in the mean, but the variances are all off. And our model does really well here, like we wanted to see. And finally, in DGP4, where there's break both in the mean and the variances, what you see is, and this is surprising to us. Originally, this was surprising to us, but actually, in that world, the sum square residual fails. It cannot estimate the threshold correctly. Originally, intuitively, we thought, well, if there is regime dependence both in the mean and the variance, surely if we just exploit regime dependence in the mean, we should be able to recover that. And that's true in the threshold model where the state variable is exogenous, but that's not true in the self-exciting model. So that's why we have this inability to consistently estimate the threshold. It doesn't help whether you have regime dependence in the variance in the second stage because you don't use it to estimate the threshold, but the likelihood does things as it should. Okay, so let me quickly go because I have less than 5 minutes now. There's some Christian added this to the paper. This is to do with more like for the macro audience to explain why, if you have a very unusual regime, that maybe you can think a little bit as an outlier, but it's a fraction of the sample size. That even if it's a very infrequent thing, if it happens in your sample, can completely change the results and leads to wrong conclusions. I think in the last 3 minutes, I'm just briefly going to touch on the application. So this is monetary policy shocks using Romer and Romer proxy for the shock. So this is like off the shelf. What we're going to use our estimation procedure. I know that you don't want to see yet another impulse response plot. So the main thing I'm going to tell you here, we have a bunch of robustness checks. In the paper, we've tried different samples. We tried to extend the sample to 2017. We tried high frequency instruments and so on. The choice of state variable for us is inflation at lag t-1, and this is an year-on-year inflation. So it really doesn't matter if you add different lags because it's pretty persistent. So you get more or less the same regimes. But crucially, when we estimate, we have 3 regimes, and we have in the paper explanation of why 2 regimes is not enough. It's really this unusual period in the sort of 70s where completely can contaminate the results. And the numbers that come out of the estimation is this 5.5 magic number, which actually I should say there's a paper by Canova and Ferrero that do a slightly different, actually completely different estimation. They allow for only 2 regimes, and the number that they come up with is 5.3, so we're very close to that. So we have a low regime when inflation is below that number, medium regime when it's between 5.5 and 11, and a high regime, which is really the thing that soaks up the, let's say, outliers or highly unusual periods of the sort of 70s and early 80s oil crisis. And this is what the objective function looks like. There is a lot of stuff in the paper on like looking at the raw data, looking at where the regimes are being estimated and so on. I'm gonna skip all of that. This is just to say, if you look at the model implied mean and variances, they are different over regimes, because remember, that's very important for the identification of the regimes. One reduced form finding is if you look at the long run correlation, this is infinite horizon, pairwise correlation implied from the model across regimes. If you look between inflation and unemployment, and by the way, I'm not claiming this is a slope of Phillips curve, it's a very reduced form object, but it tells you what, in different regimes, what this correlation between the two things is. And if you look at in the low regime, in the low inflation regime, it's negative, but it's pretty close to 0 and small. In the medium regime, it becomes very negative, and actually in our high regime, it is positive. So these are kind of stagflation periods. Persistence is also kind of important for some of the results if you actually compute this kind of autocorrelation of the model implied autocorrelation of the variables across regimes. Even if you look here, the horizon is 48, so this is 4 years. Even at 4 years, the medium regime has really high autocorrelation for inflation, unemployment, and the Fed funds rate. So what's going to happen is we're going to have responses that are going to be much longer lived in that regime. It's going to take much longer for policy to take place and also for outcomes to go back to zero. And the only picture I'm going to leave you with, because I have less than 2 minutes now, is we have these impulse responses. This is the first column is the low inflation regime, medium, and high, and these are computed. Remember, this is a nonlinear model, so there's many different ways to compute those. We have in the paper also different algorithms on how to compute different things. This is a very simple exercise where we start at the regime, at the given regime, and then we assume we stay there forever. So this is, we only use the parameter. Of course, you can do many different things, and these are in the paper. But the main thing to say is that, you know, in the low regime, you basically have very little to no effect on unemployment, on labor market, and very short-lived effect on inflation. Whereas once you go in this medium regime, once inflation exceeds 5.5%, you start getting this much bigger effect in the labor market, and also much more delayed and longer-lived effect on inflation. And like I said, there are other ways to compute impulse responses. Let me just conclude in the last minute. So we have this self-exciting Bayesian VR. In terms of the econometric contributions, they're marginal, but we think they're important for practitioners. First is that we allow for regime dependence in the variance in the first stage in order to estimate better the threshold. And the second is that we combine these frequencies procedures with Bayesian estimation in order to have a very fast Bayesian algorithm for estimation of these models. And you know, the advantages is we can handle large dimensions, pretty straightforward to estimate, and it's a very simple and transparent way to model nonlinearity that's very easy to explain also to policymakers. And I leave you with that.
All right, our discussant is going to be Marco Lombardi from the BIS.
Okay, so thank you. It's a pleasure to be here. Thanks for inviting me and giving me the chance to read this great paper. I invite you all to read it, especially the methodology part. I find it really well written and clear. So just not saying that because you just say that that's your responsibility, but I really, really like that part. But in fact, now let me put my policymaking hat, even if the usual disclaimer applies, and focus instead my discussion on what's in the paper, not so much for an econometrician, but for a policymaker who has an interest in a two-regime view of inflation. And so let me start by the first sentence in the introduction of the paper, which sort of sets the bar pretty high, because it reads, what are the effects of monetary policy on the economy, which to me is kind of a very ambitious task for a single paper. One reason why I think this is so ambitious is because, especially among policymakers, it's not always crystal clear what we mean when we talk about what's the effect of monetary policy. I mean, as an econometrician, you have in mind a certain model and shocks. There are deviations from an implicit policy rule. But we can discuss whether this is what policymakers or central bankers want to know, whether it's the shocks that, as a matter of fact, they shouldn't even exist. I mean, you run optimal policy. You don't want to give shocks on top of your policy rule. As a policymaker, what you may want to know is whether your policy framework, your policy rule, if you want to simplify, is suitable and is the best way to ensure and deliver price stability. Now that said, what the paper does in practice in its empirical exercise is to focus on the differences in the transmission of monetary policy shocks across these three inflation regimes that are identified using the threshold methodology. And the key finding in terms of what monetary policy does to the economy and what it does to inflation in particular is that inflation reacts strongly to monetary policy shocks only in this medium inflation regime. So now let me give you more details on why I think this finding is interesting and what the paper offers in terms of the interpretation of this result. So let me start from the econometrics, again, from a policy-making perspective. And let me start what is really good and what I really liked about the threshold approach is that I had the impression that this threshold model were sort of out of fashion. And I found very important and appreciated that here you make a point that these models are worth because they're parsimonious, computationally light, and especially transparent. And I think this is a key advantage over models with state variables that need to be filtered out, or models such as full time varying parameter VARs. You do full Bayesian inference, which is appreciated. You get the draws from all the parameters, which will be important for what I'm going to say in a while, including the covariances across the regimes. Now, what is a bit more disappointing, not so much on the econometrics, but on the way the model is applied to the data in the empirical exercise, is that the sample is constrained. I mean, I understand you want to cover the great inflation of the 70s, but then by using the Romer and Romer shocks, you're constrained to stop the estimation in 2007. And this is, I mean, this has two big drawbacks in my view. One is that the risk is that you read the result in terms of the great inflation versus the great moderation, which I think it's not the case, and there's more to what you do. And the second is that you can't say much about the recent wave of inflation. I saw that in the appendix you have an alternative with shocks up to 2017, but I'm wondering whether you could use something that covers the recent wave of inflation and then say something about how in which regime did we end up and how we went out of that negative regime back hopefully into a low inflation regime. Okay. So that said, let's go to my comments on the results and what they say about monetary policy if I take them at face value. So here I copied your IRFs of the monetary policy shock on inflation across the three regimes. So what I get out of this, again, if I take the IRFs at face value, is that if I'm in a low inflation regime, then you see that there is some reaction of inflation to a policy shock, but it's rather small. And so this would suggest that trying to do fine-tuning of inflation when inflation is already low, it's difficult and potentially very costly. Now, if we move to the medium inflation regime, that is where I see that monetary policy has good traction. So in that regime, it looks like you can effectively, steer inflation with your monetary policy actions. But once you enter in the so-called high inflation regime, then it looks like, again, if you take that IRF at face value, you can't get out of it through monetary policy. And just the only thing you can do is cross your fingers and hope that you get other favorable shocks that get you out of that regime. Now, the good thing from your approach is that having the full posterior distribution of all the parameters can really help you shedding light on why this is happening and what you can do about it. So let me start with something you showed already. That's the reduced form Phillips curve, or if you want, Phillips correlation across the regimes. And this, to me, this is what explains why in the high inflation regimes, things don't work as you'd like. You see that in the high inflation regime, that is the bars on the right. If anything, the Phillips curve is positively sloped. This explains why a monetary policy shock, in its strict sense, won't do much to inflation. Now, that said, we know that in the 70s, the US was arguably in a high inflation regime, and they got out of it through monetary policy and not through crossing their fingers and hoping for positive shocks, you know. But there, that happened not through monetary policy shocks within the same policy rule, but rather by changing the policy frameworks and you know, committing to something different that was not consistent with the framework that had been adopted through the 70s. So how do the implicit policy rules in these three regimes may look like? Again, having the full posterior distributions, you can kind of dig into that and get a bunch of useful findings on that. So here, the implicit policy rules, what I mean is how monetary policy systematically reacts to unemployment and inflation, to past developments in unemployment and inflation, and whether that is consistent with price stability. Of course, if a policy rule is not consistent, it stands to reason that policy shocks within that rule won't do much. And as I was saying, you can get some insights on these policy rules. First, by looking at the contemporaneous correlations. That's something I found in the appendix of the paper. From here, you can see that sorry, well, whatever. In the medium and high inflation regime, there's a reaction of policy rates to inflation as well as to unemployment. And but in the high inflation regime, there's the coefficient on unemployment is sort of much lower, whereas the low inflation regime, the coefficient on inflation is much higher. Again, this is just a contemporaneous correlation. This is not the implicit policy rule. But by looking at the full posterior distribution at the whole the coefficients, you can get a proper representation of these implicit policy rules. And I think it will be very interesting to see it as you know, a spin-off paper in which you leverage more on this empirical results. So this brings us to the end. As I said, kudos for the methodology. I really liked it, and it's explained very clearly. So it's really excellent, and it nicely illustrates the power of having a full Bayesian approach to this sort of problems. And as I said, it opens the way for additional follow-up work, including doing more with the posterior distributions that you have to characterize the different features of the economy across regimes. And yet another extension to be expanding the VAR, for example, to include the wages and oil or input prices, and that would help you shedding some light on the persistence and the transmission of supply shocks across the different regimes. And more specifically here, the policy question I have in mind is whether, depending on the regime, is it safe or not to look through the supply shocks that you may face. So that's it on my side. Thanks very much again. And yeah.
Thanks, Marco. Questions from the floor?
Okay, so first of all, thank you, because I was working on similar models and I was calibrating the direction. Now I know how to estimate it very fast. So thanks a lot. So I have two questions. One clarifying. So why the normal reshared and not the general, setup in which you have a more general prior? And a question about endogeneity of current shocks. So now the regime is predetermined, right? But I mean, in the example you're bringing, you might have, for example, current monetary policy shocks that will shift inflation from let the threshold, inflation go up above or below the threshold, right? So did you think about that?
Thank you. Any other questions? So maybe one from my perspective. So, there's certainly evidence that economy behaves differently at high inflation versus low inflation, but there are other ways to think about multiple regimes or nonlinearities. So, you can certainly go through your variables and compare how your specification compares with, other thresholds that you might put in there as well. All right, please.
Thank you so much. So let me first thank you for the great discussion. So you asked me a couple of things. First of all, about the sample. You're right. We wanted to go back to the 70s, and the high frequency shock measures don't allow us to do that. We have done robustness with the high frequency stuff going all the way to the end of the sample. And there you will not get the high inflation regime because there is no data that exceeds 11% inflation. But other than that, the results are very, very similar. But to try to speculate a little bit, we think that not having the most recent episode in the sample and then being able to say something about it that is consistent with what happens certainly on the labor markets could be a good thing, because ex ante, ex post, everything is predictable. So if we had this episode in our sample, then we would simply be fitting the data and the parameters to that particular episode. So not having it, at least this is one way to speculate about this. On the IRFs for inflation, I totally agree with you, and actually your suggestion to look deeper into the policy rules in the Bayesian posterior is really useful. Unfortunately, we had the paper just accepted, and I don't think that we can incorporate it in this in this paper. But Valeria continues working on this, so I'm hoping that maybe I'll pass that on to her. Then you comment on the larger set of variables. For sure, again, it isn't in this paper, but the methodology, the fact that we can do much larger models and shrink and do fast inference means that maybe the methodology is useful for looking at wages and supply and demand shocks. Then I had questions. So on the normal Wishart prior, I mean, the answer is convenience, right? Because when you have the Gaussian, when you assume Gaussianity and then you have the normal Wishart priors, you don't have to do MCMC, right? You have closed form conjugate, conditional and gamma conjugate posteriors, so you draw using simple Monte Carlo draws. Of course, you can do anything else, but then you start getting slower. Not very slow, but again, you will have to do proper MCMC in that setup. But no other reason other than that. Also, from a sort of more asymptotic perspective, the prior doesn't matter, right? It's just a device in order to penalize. Minnesota type prior is something we know how to use really well, because instead of having to specify this massive shrinkage variance matrix, we just have to pick one shrinkage parameter, and so makes everything really simple. On the endogeneity issue, I think that, I understand that from structural point of view, like it's very interesting to ask what happens when the current FT, variable, shifts the regimes. But I know that from an econometric point of view, you cannot estimate that model. You could, if your state variable wasn't one of the dependent variables. If your state variable was some exogenous thing that came from outside the model, and then you write all the assumptions of the model conditional on that exogenous state variable at time t, then you're in the game. But in the self-exciting model, you cannot estimate the model. You have all the assumptions being violated if you added that st. You would really have the left-hand side and the left-hand side variable at time t appearing on the right-hand side of the equation. You can try and rewrite it, but I don't think that estimation will work in that in that framework. Thank you for the question as well. So in terms of course, the methodology is general. I think you can add any state variables. We played we've played with this. We tried, I guess we tried having interest rate as a state variable and have like above and below zero, or above and below something effectively close to zero. You can do that. You can also write a much more complicated state variable. That's for example, interaction between state variables. So you have, low inflation, low unemployment, low inflation, high unemployment, and so on. You can do all of that. At the end, we did some robustness checks and we did try, but from all the evidence that we have on how agents behave, like this recent RCT paper, we thought that the relevant state variable is inflation, because also that is what the policymaker is focused on.
Good, thanks. Anything else? Any other questions? Yes, please.
Just a quick question, maybe also to connect to the previous paper. So you validate the model through Monte Carlo, that's more than fine, but did you try to look at the forecast of the model, or the forecast performance of the model, is even compared to other possible linear or non-linear model? And in particular, because your conditional forecast would be non-linear, will be non-Gaussian, right? And you can measure a balance for risk, because it would be a mixture of three normal, I guess, depending on the probability of ending up in one of the three regimes tomorrow.
Thank you very much. So first, on the Monte Carlo exercise, the reason why we have this is kind of like a sanity check, because like I said, to do the full consistency proof for this, regime invariance, that's something that I think Valeria needs to work in her second. So this wasn't really part of the paper, but we wanted to make sure that everything works exactly like expected. In terms of conditional forecast, you're right. Like, this model can generate really interesting stuff. I actually had a lot on that, and that didn't, at the end, it's not in the paper. We got rid of it. But you're right that this model is interesting to forecast, and also even for computing the different impulse responses, because what happens is, first of all, the initial condition matters. So what state of the economy you are would determine which parameters to use, because it determines which regime you're at. But then once you start going forward and computing the forecast, you will have, either you drawing shocks, or different shocks, different sizes and signs of shocks will push you in different regimes. And then once you're in a different regime, you change the parameters. And so you get really interesting conditional forecasts, which are not the same at any different point in time. The model will imply very different condition forecasts. It's definitely something we looked at. In the end, the paper is finished, and it's only about policy. But I agree that this is, from my perspective, is a lot more interesting. But you see a little bit of this conditional forecast in the impulse response, in the nonlinear impulse responses that we compute, because in those, not the ones I showed, you have different starting dates, and then you move forward with a model given a shock and without a shock. You use the full nonlinearity of the model, and in the end, you compute the impulse response as the difference between the universe with the shock minus the universe without the shock. Thank you.
Right, it is 1700 and we are right on time. So let's give our last panel a round of applause, please.